Hi, everyone, and welcome back to the Nick Halaris Show. Our guest this week is Tracy Gray, the founder and managing partner of the 22 Fund. Tracy, welcome to the show.
Thanks for having me, Nick.
Well, thanks for being here. Ever since we met, back several years ago in the dark days of the pandemic, I've been interested to learn more about you and about the work you're doing and about the 22 Fund. So just happy to finally, get this opportunity to talk with you. So appreciate you taking the time. I figured a good place to start is just kind of with what you're doing right now. Tell me a little bit, tell us all a little bit about the 22 Fund and what you're up to.
So thanks again, Nick, for having me. The 22 Fund is we call it an early growth venture fund. I tend to make up names of things that if I'm filling a gap and they don't exist, I make up our own name. So we're early growth venture fund. We invest we're a climate justice fund. We invest in climate tech, clean tech manufacturing to help increase their export capacity. That's our strategy, and our mission is to create what we call the clean quality jobs in low and moderate income communities and generate generational wealth for women and people of color in those communities. Our strategy causes our impact. We don't have to twist ourselves in a knot to get to that impact, and our return. So we're return driven and impact driven, not concessionary, but they're even. We're not returns first or impact first. They're just, I believe they could be on par even. So the reason why our strategy, this unusual strategy, and no one else were the first one to do this, the reason why this strategy is different and why we chose this is because, first of all, of course, climate is important. And we started it when people left climate tech and clean tech. But manufacturing, because manufacturing creates jobs, higher paying jobs. And we have a lot of manufacturing here. A lot of people think we do not have manufacturing, but we do. Matter of fact, LA has more than Michigan, all the state of Michigan combined. And so manufacturing is really important to communities and to people of color and to our whole country. But there's not a lot of investment in manufacturing or hardware because of the CapEx, and it takes too long to exit hardware to other venture capital. But we layer on exports, which is selling your product. You're located here in the United States and you sell your product outside the country. We layer exports because that allows manufacturing and hardware companies to have venture-like growth. That is why we have that strategy with exports from a returns point of view. So companies that export have 37% higher revenues, 25% more likely to make it through a downturn. So they're 25% more resilient. And then they have to be, then you can move on to the impact side. They pretty much have to be in low and moderate income communities. They can't be in the Upper East Side of New York. They can't be in Beverly Hills. So those jobs will go to those communities. And when you layer exports on top of manufacturing for the impact side, the wages are like on general manufacturing wages are $88,000. When you layer exports, it's $94,000 on average and more likely to have health care. Yeah, so I'll stop there.
Yeah, well, that's incredible. Lots of follow-up questions I want to get into. One of them is you're just kind of finishing up the fundraising process. And I'm curious, just given the uniqueness of that strategy, like what have those meetings been like? Like I know venture sort of has a bad rap. Like these days, they're looking for the next AI. Before that, maybe when we first met, they were looking for the next cryptocurrency to back.
Mm-hmm.
And they want these like wild, like no real investment companies that can scale to $1 billion with no CapEx. What have they been saying about your strategy? What are those meetings like?
Well, they've changed over time. Right. So we launched in 2019, I guess the fundraising we launched in 2019. We launched the fund. We started doing everything we need for the fund in 2018. Back then, it was pretty much, we don't believe in climate tech. We're not going to invest in climate tech. There's no manufacturing in the country. And there's too much risk in exports because people didn't understand either any of those things.
Yeah.
Right. So it took from your traditional investors, it didn't get anywhere. Right. It didn't get anywhere. So then as things did right before, when George Floyd happened, everyone was like, where's my Black person? And so all of a sudden, like, and there was not, I'm still one of the few Black women and just people of color in climate. Right. There's very few of us. But back then, I was one of the very few firms that were already out in the market fundraising. So that helped a bit, but that's when we kind of changed to more impact investors. So foundations and family offices that cared about impact, but they take a long time too, and they write smaller checks typically, on average. So we thought that would be easier, and it was easier for the smaller checks, but not for the size checks we really wanted. Plus, a lot of the impact investors from foundations and family offices, they use the same Wall Street dudes because they're usually same Wall Street advisors. So it doesn't matter if you're impact or not, or they're still coming at it from the same way you would do if you weren't an impact fund and they didn't care about it. So it's been a journey. People were learning, we were educating as we were fundraising. We didn't know we were going to be doing that. We thought, people know this, but I guess I'm an engineer. One partner is an engineer. And then another partner is very international, like her whole career has been international. So all the things we thought were just like a no-brainer, most people don't really understand.
Yeah.
So that made it difficult. And then people started after First Republic Bank, not First Republic, I was going to say Silicon
Valley
Bank.
Yeah. Silicon Valley
Bank.
Bank. Yeah.
Yeah, Silicon Valley Bank. When that happened, a lot of stuff just went to a screeching halt. When the really right wing groups started suing around ESG and DEI, people ran scared. So a lot, and then there's been like, is there going to be recession, inflation? The bigger macro kind of thing happening. It slowed down a lot. So we've seen it all. Let me just tell you, we've seen it all.
Yeah. Yeah. It's been an incredibly challenging environment.
Yeah.
One of the things that I've been thinking of, because I've interviewed a number of people kind of in the impact investing world or trying to be in it. And one of the things that I've noticed, I'm curious if you had this experience, is that people who are putting themselves out there as like so-called impact investors, outside of maybe like the foundations, they're looking for like normal returns. Like there's no like difference in their return expectations. Are you seeing the same kind of mentality?
Well, some we mainly see this because that's all we care about. Not all we care about, but we're still returns driven.
Sure.
No concessions. So we go to mainly the investors who are the same. There are on the foundation side, and there are more progressive investors who are like, why are we always returns only? Why are we driven? Why can't we be somewhat concessionary? Almost like a blended finance point of view, some concessionary, some not. Like coverable grants, things like that I see. It just depends who at this point I've learned who I need to go to, and I know who is whom and who will be a fit for us. So I'm not sure I can count on the trend because I'm self-selecting.
Got it.
Who I'm talking to.
Yeah. I just got this feeling like I had worked on it a little bit with some real estate strategies that we were considering, like building like fully affordable buildings. And I talked to a number of groups, and I just got this feeling that a number of people, this isn't true of everybody, but a number of people who are holding themselves out as impact investors are not really impact investors because they're just looking for deals that look and feel slightly different, but they want the exact same thing. And in my mind, sort of like part of signing up for impact is that you would consider something else. Like in my world, like if you want a 17 IRR, line up with 100 other firms on Wall Street who are looking for the same 17 IRR. So it kind of rubbed me the wrong way. And I just was curious what your thoughts are on that.
And real estate's very different. right, than what we're doing. But I think we probably see similar, and sometimes impact is marketing. It depends if you're talking about the LPs going in or the funds themselves, the GPs or the LPs. There's a lot of GP marketing around impact when I'm not sure they're really impact. There are some bigger corporate LPs that did, they were we've learned that the equity and diversity money they pledge or want to do, all of a sudden they pulled it back. So that wasn't real for them. They were just doing it when it was on trend positive, and now there's some negative for them, so they pull back. So that's not. So I think there's all sorts of colors, and I can be a person that's really judgmental, and I can label you, put you in a box pretty easily. Try not to, but I can do that. But I am seeing just a blend. I don't know if I can even. You're going to see what you've seen, especially around affordable housing. You're going to see it.
On the other side of the ledger, you've sort of created an interesting strategy, and it's very specific, right? It's women owned, it's climate justice related. Like, how many companies out there check those boxes? I missed one. I missed one of the boxes, but there were several boxes.
Yeah, there's lots of boxes.
Yeah, there's more boxes, but like how deep of an ecosystem is that of companies like that are looking for money from a group like yours?
So first of all, it's women and people of color. So not just
Yep.
women. And then we have there's no one else investing in these companies. There are tons of them because traditional venture is not going in. One, they don't understand manufacturing or climate or hardware. Like the majority of venture capitalists are software driven. And we did a white paper called Innovating Impact. And we did that to try to explain to folks that we can't software ourselves out of this climate emergency or anything else. We need to make things.
Yep.
We need hardware, we need manufacturing, we need some other funds, a fund I know called Tech You Can Touch. And so there are so many companies, and another thing, VC waits for people to come to them. And, if their networks look like them, that's the only people that are going to come to them. We intentionally go out. If we sat and waited for people to come to us, we would have, we have like 300 companies in our pipeline of companies that are fit or don't fit or might be fit later. And that's just people coming to us. We intentionally go out and we know what we want and we search for those companies. And these companies can be anywhere from 15-year-old companies to 40-year-old companies, right? They've been around a long time. There's no ecosystem around this. That's the other thing. There's no ecosystem like traditional venture capital. These are some family-owned businesses that have been around for a long time, and they don't even think about their capital needs. They don't know what a Series A, B, and C is. They don't know sometimes don't even know what equity means. They know equity in their house, but they don't know what that means for someone. They'll go from, I understand equity in my house to, that means you're going to take my business, right? They know private equity and they can take my business. There's an education to the entrepreneurs. Their only source of capital a lot of time has been loans. Some of them might be LLCs, and we can't invest in an LLC, so they've got to convert to a corporation. So that's a long way to say we have to be intentional and go look for them. But then we know there's a ton of them.
Yeah.
And that's why we know that, you could have a $300 million fund and still not cover it all. And that's also why when investors or people ask, who's your competition? We don't even think about competition. One, there's none. Two, it doesn't matter. There's enough companies for more of us coming in and investing in them. And so plenty of we always say deal flow is not one of our problems. We're not competing with because we're not competing with other VCs, we don't have to rush. A lot of VCs, you get someone saying, we're going to close in 2 weeks if you want in. We're like, go ahead and close. We don't care because we take our time with our due diligence. We're not playing that game. So, and we invest in mainly cash flow positive companies, not really early stage. That's what we call early growth. It's that kind of place between venture and growth equity. We're kind of in between there. So they're existing businesses, so their numbers aren't made up. Venture capital can do their due diligence faster because the numbers are made up usually, right? The projections.
It's completely fake. Yeah.
Everything's made up, and I try to tell people that it's like a lot of entrepreneurs are like, I need to be more conservative. It's like, why? Make it up. They're making it. Your investors are making it up. Just make it up, and then you just have to get there. But these are real businesses for us, so we have to look at everything. We have to look at their contracts. We have to look at everything and make sure it is, buttoned up. So it takes us longer to do what we do. And I can't remember what your question was, so hopefully I answered it.
No, you did. I was just
Okay.
trying to get a sense for like what the investing landscape looks like, and it sounds like it's pretty robust. I mean, look, if you have
It's huge.
if you have 300 companies already in the pipeline of potential, like that's enough to make some investment decisions and allocate a bunch of capital. So it's a big.
Yeah, and we write bigger checks. Like our sweet spot average of 5 million. So we're not 250. So we're
Yeah.
only going to only invest in 10 to 20 companies, depending, size checks we write and follow if we want to follow on, reserve for follow on. So we can take our time, over the course, the term of the fund, get to 10 to 20. We don't have to rush. We can take our time and find the real good ones.
Yeah, that's very cool. Yeah, I feel like the venture, we were just joking about the venture model being fake, but it is actually an incredibly powerful model when you think about sort of the way it divorces the mentality from spreadsheets and things like that and allows you to think bigger. And so it is cool to think that you could bring that to like, quote, older style businesses like manufacturing, bring that there and allow entrepreneurs and business owners the opportunity to do something besides take on some huge loan, which it sounds like that was the sort of only avenue for success. Because there is power to the venture model because it divorces you from these like ultimately false restrictions, which is how big can you think about your market?
Yeah, I mean, for us, the reason I think equity is important is because equity capital allows you to grow really fast because you're not having to service this debt.
Yeah.
That's why these companies stay small. That's why there's not many, when people say, oh, there's not a lot of women or people of color that get over $1 million. Well, it's not their fault. It's the system that doesn't allow them to have the capital to get over $1 million.
Yeah.
So it's almost like gaslighting that you make it sound like it's their fault. Oh, they're not good enough because they can't get over $1 million. So we'll wait till they can get over $1 million. No, it's the system's fault because it is leaving out when Black women get 0.006% of all venture capital, but we're the most educated of all demographics, and women get 2%, less than 2% now, I think. Yet our businesses are more successful. Something's off, and it's not the women, and it's not the people of color. It's the system, right? So equity is what helps you grow super fast. You can't with debt. You just can't grow fast with debt. It takes a long time. It's almost impossible. So these companies can get bank debt, factoring, PO, financing. You can't grow fast on that. You can't even plan around it.
Yeah. Pay 15% interest on your accounts receivable factoring. Yeah, that's nonsense. Yeah. I knew the numbers were bad for VC, but I didn't realize they were that bad. 2%, that's wild.
Yeah.
That is
people of color, just period, are less than 1%. That's all people of color, right? So white men are way over indexed with this money. I mean, even with assets under management, period, all assets under management in the United States and around the world, 98.7% are controlled by white men. Yet that's too much to some of them that they're suing little Black firms in Atlanta to stop them from investing in Black women. Like 98.7 is just too much. Now we got to go after that 1.3 that's left there. We got to have it all. So people don't realize, all the protests and fighting for this, people don't realize how bad the numbers are. They're really, really bad. And it's impossible to be at this level organically when 51% of the population is women, 40 something right now is people of color. How do you get 98? It's not unconscious bias, which is what we used to talk about a lot. This is conscious, statistically impossible with the rate of, and women and people of color, women of color especially, are starting businesses faster. So there's more of them, but from a percentage level, it's never changing.
It's really like sobering. In my view, like the equity part of the DEI is the most important. I mean, that's all important. The equity is important because we live in a world where like it's basically money that moves it. Whatever you want to say.
Yeah,
whatever you want to say about it. It's money. You need money to do anything. Win an election. You need money to win an election, to start a school, do a business, whatever. And the equity numbers are really bad. What's really scary about this country is that their probability of sort of breaking out of a bad situation is going down and down and down. And so young people are feeling completely disconnected from like a future.
It's getting worse.
Yeah.
It's getting worse because of the powers that be and the very, very wealthy white men who just don't think like sharing their wealth is important. Like, I don't know how $1 billion is not enough for you. Right? Why is that not enough for you? You know, what did they just said that Jeff Bezos, and he does a lot, but you know, he's $200 billion. He can never spend that in his lifetime. And I don't know how many generations could never spend that. And you may not have future generations because of this climate situation. So what is it? Why do you have to hold that? Is it just ego?
Yeah.
You win. It's just winning. It's just like, it's crazy to me. It's crazy.
It is crazy. And it like when you try to think and brainstorm, like, okay, how could you actually fix that? Like, just take the venture stuff, right? How do you go from 2 to 51? That's actually not like an easy question to even like think about trying to get that done.
It's not. It's rocket science. And I worked on the space shuttle program. The engineer on the space shuttle. This is not rocket science. I know what rocket science is. This is easy. This is one time trickle down economics would work. The allocators at the top are all white dudes. So we need more people of color and women at the top. And then they will invest in more venture funds of women and people of color, because it's already proven that if you have women and people of color, they invest in more women and people of color. So that's not hard to do. It's letting go of power that is there. It's hiring the people. I mean, there's only 6% of venture capitalists are women, and less than that are people of color. So there's so much room. It's not hard. They like you to think it's hard to keep hold of power, but it's not hard. It's not hard.
I see. So your thought is like, if we could change those leadership positions, like how fast could it happen?
It can happen immediately if they let it happen.
Like one generation, like one cycle, one venture cycle, something like that.
It could happen. I mean, we could do that in 5 years. We can do that.
Yeah,
definitely in 5 years. You can. I see these allocators. I see the owners, asset managers, and asset allocators, who they are. Even on the foundation and impact side, it mirrors Wall Street. It mirrors Wall Street, and that's not what it's supposed to do.
Yeah.
So if you have to, I mean, for me, I'm like, fire folks.
So another topic that I wanted to pick your brain on is the whole climate side, because I got this feeling when the war started in Ukraine that like a huge like momentum got sucked out of that whole industry. Carbon prices, like the carbon credit prices collapsed, and no one seems to be caring about the climate when we're like, people are bombing each other left and right. But what have you noticed on the ground fundraising and talking to companies? Is that a true assessment, or is there still optimism in the space?
No, I think, I mean, there's so many differing things on carbon credit. A lot of people don't want them anyway, right? Yeah. So here in because of the United States, let's start there. The United States, because the Biden administration has put an unprecedented amount of capital toward climate, infrastructure, and manufacturing. I think someone said that in today's dollars, and I might be making it, but I feel like this is right, it's like 7x more than the Great Deal, the Great New Deal, or what was it called, the Great New Deal?
The New Deal, yeah.
The New Deal, yeah. So there's a lot more capital going toward it. There are huge funds that are being raised really quickly. What they're going to, I mean, but mainly it's these big infrastructure projects instead of, I'm not sure what's happening around entrepreneurship and innovation, but I don't think people are leaving because they know the risk to their assets if we do not even, we can't solve the climate problem at this point if they don't even address it and address it fast. Other than, energy, oil and gas, I don't think there's a pullback. I think the oil and gas companies, they know the writing's on the wall, so they want to be part of the conversation. So COP 28 that we just had in Saudi Arabia, was it Saudi Arabia? No, UAE, oil, that was there for a reason. They're trying to get in there. So I think we're going to have there's a lot of tension around that. They know what the writing's on the wall. Everyone else knows the writing on the wall outside the U.S., outside of the Republicans they know the writing's on the wall. They just don't want to be part in it. They just want to, I don't know why they do what they do. Anyway, not to make this political, but the rest of the world understands. They understand. It's just how we going to do it. We have till 2030 here to do what we need to do and stop blaming everybody else. Just do what we need to do. We're the biggest one. So, that was a long way to say I don't think people are pulling back.
Okay. Well, that's good. Yeah, because it feels like that's a narrative that is not as popular. Like it was very popular for a while. I mean, I guess it ebbs and flows, but Europe is fully committed, obviously. It seems like China is committed. And the question is like, what are we going to do? We're the biggest economy in the world still. Yeah.
I mean, this administration's committed. The problem is we're a democracy. And the next minute, if Trump gets in, they're going to roll back everything again.
Yeah. What did he say? Drill, drill, baby, drill. That's what he said. His campaign slogan. Yeah, we'll leave that for another podcast. Yeah. So I wanted to ask you, you mentioned, and I heard this on another podcast, that you are a rocket scientist working at NASA. We should talk about that. But before we talk about that, where did this passion come from for you? Like you have a mission and you're putting yourself on the line and doing something that is difficult, right? Like you're trying to start a fund in a space where no one's really done it before. So where does this all come from for you?
I mean, so many different things. I think one, I'm a Taurus. So don't tell me I can't do something. I'm stubborn and I'm going to do it until it kills me. I mean, I think I'm very stubborn. I really do not like people to tell me something I can't do or something's impossible. And that makes me, because I'm a systems engineer, right? I was a systems engineer. I worked in rocket science. Some other rocket scientists if they tested me, they would say, she's not a rocket scientist, but I worked in rocket science, and I was a systems engineer. I studied rocket science. But as a systems engineer, the system can't work if one part of it is broken. It's impossible. All systems. So the financial system, I'm an engineer. It doesn't work. There's a gap. And I need to fix it. So I'm an engineer and a fixer. So with being stubborn, an engineer and a fixer and liking to fill gaps, because I also get bored. I don't like to copy and paste what everybody else is doing and maybe pink it for women and black it for black people and brown it for Latinx people. Why do that? Because it wasn't created for us or by us, yet we think we can just color it and it's going to work for us. It doesn't. So I've just always been, and I've been driven by justice my entire life. And that came from my father and mother. I know that 100%. I remember, because my parents are from the South. My dad had to go in the military really young, like 15 or 16, because no opportunities for black men in the South. Created opportunities for us, but he had to be on the front lines in wars where the white guys were in the back, right? In the offices. So he was shot. He was in 2 wars. So the sense of justice around that, he was very political. And then I think my personality is, I don't understand why things aren't fair. I just don't understand it. That's another thing. I'm an engineer. Logic is everything to me. And justice is everything to me. So if it's logic, if it's illogical and unjust, my head, I go crazy. And I have to fix it, which is really not always a great trait, because I'm trying to fix everything, and I can't do that.
Yeah. And these systems of power that we've been talking about here, about sort of the follow the money, that is a very tough one to tackle because the stakes are so high, but it's an inspiring. Yeah.
I was talking to someone else and I was like, we were having a meeting about something else in the system that we were working on fixing. And I was like, gosh, wouldn't it be nice to be a white guy where you just have to have your full-time job? That's it. You don't have to fight the system. You don't have to save democracy. You don't have to fight for women's reproductive health. We can just do our job and be rested and not exhausted. But all of us, women, especially women of color, if you looked at our portfolio of work we're working on, it's like our full-time job will take 60 hours a week, and then we'll keep going with another 40 hours a week on some side hustle that is not a side hustle that pays us, but it's trying to help people and try to change something. Like if you saw our portfolio around that stuff, you'd be like, what the heck? How are you guys doing it? We're just exhausted.
Yeah. That's an interesting point you raise. I'm pretty active, like civically around town, and
Yeah.
I don't have great data on this, but just hearing you say that, I feel like
Oh, I
it
lost you
is
again, Nick.
empirically true that white males are like underrepresented in that work, meaning like there should be a lot more white males involved. And if you looked at sort of other communities, the number of people percentage wise who are engaged in civic activism or whatnot is quite high, actually. Which I
Yeah.
never thought about that before. Yeah.
Yeah. If you look at who does, like, it really, Black and brown women, we get out the vote. We organize, get out the vote.
Yeah.
So we really are the ones saving democracy and saving everything. But we don't get we don't want to get. I think we get some credit, but we don't get to raise the money in the rest of our lives. That's the one place we're allowed to raise money, because it helps everybody. But
Yeah.
our funds and
It
everything else.
typically helps a white male get elected to office. Historically, I think that's changing though. I think that's changing, but historically that's basically what's happened. Yeah.
100%.
So just was fascinated by the story about your father. What state did you grow up in, and what wars did he serve in?
So before he retired in Santa Barbara County area, Lompoc.
Mm-hmm.
But before, so I grew up pretty much in California after he retired.
Okay.
Before that, we were in the South, Mississippi. We were in New Jersey. I was born in Omaha, Nebraska. I grew up for about 4 years in Okinawa because my dad was there.
Yeah.
My sister was born in Libya. So we were in all different places until he retired. He was in the Korean War and the Vietnam War, both of them.
Yeah. Wow, that's a long term of service. I mean, that's like 2 decades of service.
Yeah, he was 20.
Incredible.
He started in the Army when he was younger. And then, I hate to say this, anyone who's in the Army on here, forgive me. But he said, those dudes aren't smart enough. That's pretty much, he said.
Yeah.
So my dad was super smart. And he said, but then he didn't want to be in the Marines because they're just too, and he wasn't a water guy. So Air Force that's where he thought all the smart guys were.
Yeah. That's funny. My father-in-law served in the Air Force, enlisted as well. Like he grew up on a peanut farm, and he was like 17 and he was like, okay, I can do this or I can enlist in the Air Force, and he chose to enlist. Yeah. Yeah. That's incredible. So tell me, I guess we're running out of time and I just want to wrap this conversation up. Appreciate all the work that you're doing for the community, and I'm rooting for the 22 fund. I'm looking forward to seeing what kind of investments you do. What's your grand vision? Like, take me 10 years into the future. What's 22 fund doing?
Well, so we've invested in 5 companies, really good companies. Two of them now are in Los Angeles. 3 of them were. 2 of them came from the LA Clean Tech Incubator, where I was a executive in residence, and so was one of my business partners. But my vision for the 22 fund is, I've seen so many women, especially women of color. It's taken like 3 to 5 times longer to raise a venture fund as a woman of color than white men, probably 2 times longer than men of color, and 2 times longer than white women. And so I was recently in New York. I just got back from New York, and I was talking to a fund out there, and I said, what I really want us to do is just roll up a bunch of our funds and become like a KKR or a Blackstone, like a really big venture private equity fund that can have multiple stages of investment, multiple industries, like have the power that they have to do whatever they want, and then they raise a huge fund. Right now, there's a lot of, I don't want to say mission creep, but a lot of the investors telling us what we need to do instead of us saying, this is what we're doing. Because there's so little money that you're just like, it's like whiplash. You have to like look all over the place. And we did that for a while. And then we were just like, no, this is our strategy. Take it or leave it. We're not going to pretend to be anything we're not. But a lot of women of color are having to do that. So like rolling it up, maybe I have a whole new name, but it'll be like, everyone knows this is one of the biggest venture funds run by women of color.
Yeah, I love that. I feel like that is a missing piece in a lot of the conversations around impact in general, and sort of working on the equity piece of the DEI equation, for example, which is the true way to do this is to win. You have to win and get a seat at the table. And the only way to win is to create a competitor of the same power and scale. So I love that vision. I feel like that's super compelling.
Yeah, but I don't think about winning. I mean, it's a very male thing to think about someone wins. And really it's just all, and I'm not interested to get a seat at the table. That table was not made for me at all. I think I'm going to make a better table with way better wine, right? Better food. I'm not interested in being at that table. I've been at that table pretty much all my career, kind of, because of what I've done. I've been in spaces with mainly men, as an engineer and an inventor. I'm always in spaces with mainly men. Even getting my business degree, it was mainly men.
Yeah.
So I've been at that table, and it's just not it's not me. It's not my crowd. So we creating new tables that look differently. And that's kind of like what you're talking about with equity. At their table, I have to accept the seat they give me. And they'll probably not give me an equitable seat. They'll give me maybe an equal seat. But I really, because we've had so much against us, we need more. Like I don't know the analogy, but I need to see the head of the table, but they would probably put me at the children's table next door. Right. And that's equality. You're in the room, but we're going to put you at this other seat. But I need to create my own table and be at the head of it. And there's so much money out there. There's so much money. They don't have enough places to invest in, literally. So there doesn't need to be any winners. There just need to be more. There should be more of it. And that's what equity is about. And so I don't think about winning or losing. It's a win-win. That's how I think about everything. Win-win. No one has to lose for me to win.
Yeah, that's fair. And what I meant by winning is like the fundamental equation is that you need to be able to sort of set your own terms. Like KKR is essentially setting its own terms when it comes to its money. Maybe they have some LPs, like some pension funds that kind of can have the conversations that people are trying to have with you, like, oh, maybe you should invest in this. But by and large, KKR is setting terms for its investment. And that's what I meant by winning. But I agree with you. Like there's the work that you're doing is not a zero-sum game at all. There's nothing zero-sum about it. It's like just uplifting people and finding opportunities. And it doesn't matter how many sort of quote wins you have, no one's going to get hurt by it. And that's what's beautiful about it.
And what's interesting though with BlackRock, I can't remember which one it is, but they actually, when these Republican attorney generals said, if you use ESG, and they don't even know what ESG is, right? They have no idea. These attorneys, we're going to pull out money from you. For a while, BlackRock was like, go ahead and do it. And then they're like, uh-oh. So they're getting scared by Texas not putting their money, not the Texas teachers and the Texas retirement system not going into their funds. They rely on those. But they don't have, they're powerful enough to say, okay, you're not going to be in our fund. Let's see if you get your returns that way. But for some reason, they're not doing that. I'm not quite sure. It's a weird time. It
is a weird time. Yeah, that's interesting. Yeah. Well, Tracy, thanks for taking the time. I really appreciate this conversation and looking forward to following the 22 Fund and following your work and keeping in touch. Thanks for being here.
Nick. I forgot for a while I was on a podcast. I thought we were just shooting the shit.
I'm glad. I'm glad because that's the intent. Like, I always say when people ask me about podcasting, like the best podcasts are the ones that the way you describe it, because sometimes people have a tendency to just like monologue and it's not as fun. Mm-hmm. It's way more fun to just do what we did. So thank you. Yeah.
Thank you. I enjoyed it.